Thanks for joining us for another episode of Ask Spurrell CPA. Today we're talking about understanding your balance sheet. I have Laura here with me once again. So, Laura, how was your first T4, T5 season? What was that?
Busy. We got it done.
Yeah, a lot of emails to process. So, we're happy to be clear of that for another month here. And the quote that I have, dealing with our topic, understanding your balance sheet today is Albert Einstein. It is, if you can't explain it simply, you don't understand it. And that, is great when I think of a balance sheet and the questions people have on balance sheet and the explanations they get sometime. And, if it's not a simple explanation, it's usually wrong. So the statistic, 50% of all Canadian small businesses, don't make it past 5 years. And, the ones who do, sometimes they have challenges as well. And one of the big three reasons why they fail is they run out of cash. So, the story is, we have business owners that are making critical business decisions on an income statement, but the real information that they need is on that balance sheet, which they just, don't understand, or sometimes don't even make an attempt to understand because they think it's, so far, beyond them. So Laura, what are the questions you think these business owners should be asking?
Why do you always insist on looking at the balance sheet first?
Yeah, so whenever you're looking at, especially interim financial statements, there's a high degree of risk that there's an error in misstatement. It's not a perfect science. You're always balancing, a reasonable budget to prepare the items, versus the accuracy, right? So if you and often there'll be a glaring error on a balance sheet. And if you never look at it, it's going to show up that balance sheet item is going to have a significant, relate to a significant misstatement on the income statement. And you might, decide to purchase a new piece of equipment or hire a new staff member or let a staff member go thinking that you can't afford them when really you can. And if you would have just looked at the balance sheet first, that would have made all the difference. Plus, the balance sheet, speaks to your reserves and what's coming in. How liquid you are, how much cash you have in the bank, what are the receivables that were coming in, what are the payables that are going out. So it has real critical information concerning the liquidity of the company, and which is not going to be shown on the profit and loss statement. Just because you had a good month doesn't mean you're in a good liquid situation at all. So I always say it's balance sheet first, and then it's profit and loss, and that's just the discipline that you should stick to.
How does looking at a 6-month comparative balance sheet help?
Yeah, so the 6-month comparative is going to draw your attention to any variances over time that don't make any sense. So a lot of business owners, they're not CPAs, but simply if they look at a 6-month comparative, they'll know enough and start to gain enough knowledge to really recognize those variances. So when we present balance sheets, interim balance sheets to our outsourced accounting clients, we're always looking at that 6-month comparative, because looking at 1 month alone, it doesn't give me all the tools that I need to recognize that something could be misstated. But if I look at 6 months, I know what happened in January, February, March, April, May, June, and there's a number that doesn't make sense. There's a variance that's, historically, the receivables are really high. There's this new prepaid, or, the equipment went up or down dramatically. It draws our attention to it. Whereas if we just looked at the current balance sheet, we would never glean that sort of information. So that 6-month comparative is the powerful tool to recognize variances, which may or may not relate to a misstatement.
Why can cash on the balance sheet be different than the bank statement?
So the cash on the balance sheet, we have to understand, it can be subject to uncleared items. So for example, if you have the cash on the balance sheet, if you've written checks, for example, so your bank balance is $100,000 and you've written a check yesterday for $80,000 and sent that in the mail, and the client, the supplier hasn't yet cashed it, your balance sheet is only going to show there's 20 left. It's assuming that check is going to cash at some point. But your bank statement will still show that you have $100,000. So in your mind, you might be thinking, I got lots of money to pay payroll. But really, once that check clears, that payroll is going to bounce. So we need to, understand those uncleared items. They can work the other way too on deposits. Checks can be outstanding for a little longer, but the deposits are usually a little bit shorter. So you could have a deposit. They rang it through the credit card machine yesterday, but the bank balance doesn't quite reflect it the next day. It might be 2-3 days before it hits the bank. So The balance sheet bank balance has those uncleared items. Once they clear, what's the real, once the smoke clears, what's the real bank balance going to be?
What will generally happen if your accounts receivable is under or overstated?
So if you have an accounts receivable and let's say it's overstated, really people owe you $80,000, but your receivable balance is showing that people owe you $100,000, you probably have an extra $20,000 of revenue booked somewhere. Maybe it's a duplicate invoice. Maybe there's some sort of typo error in it. So when we're looking at that variance here and we have an overstatement in AR, we probably have less revenue. We probably have more revenue on the income statement than should be. So again, it's an error that you'll pick up when you're looking at, hey, every month customers owe me about $40,000, and then this month all of a sudden they owe me 80 grand. Okay, do they really owe me 80 grand, or was there a problem in this AR listing at all? Same time, if there's less AR, we've underreported the revenue. It can make it look like the business isn't making any money when really it is. We're missing that invoice never actually got entered into the statement or entered the incorrect amount. So,
what should be added to the property, plant, and equipment section?
So generally added to the property, plant, and equipment, these are long-term assets. I'll define that as they have a useful life of longer than a year. And I would say, just for simplicity and logistical reasons, that their asset value greater than $1,000. It's no point, counting assets that are less than $1,000. Even if they meet the technical definition, it's not material. You're just going to drive yourself nuts. Maybe buy a stapler for $20 and you can use it for 5 years, but do not put that on the balance sheet. Put assets, significant assets, $1,000 or more, and that's what should go on the balance sheet. So significant assets with a useful life of more than a year. That's what belongs on the balance sheet, property, plant, and equipment section.
What will generally happen if your accounts payable is under or overstated?
So it's kind of like the receivables, but the flip of it. So let's say your accounts payable is understated. That means you haven't entered all the invoices in. So you can see all the revenue on your income statement, but if you don't have all the payables listed on your balance sheet, those expenses are understated, which means the profit looks better than what it actually is, right? At the same time, if there's something put in the payable section that you don't actually intend to pay, maybe contractor didn't deliver and you had to go to a new contractor, and now you have the old contractor's bill that you're not going to pay on the payables and the new contractor's bill also on the payables, your income statement looks like you're making less money than you actually are. So any under or over statement in accounts payable has an effect, up or down on the income statement as well.
What is generally going on if your credit card balance is unchanged or negative?
Yeah, this is like a common one. You'll see it, and you're looking at that 6-month comparative balance sheet. Remember, that's going to give you the information, and you see your credit card balance, and month one is $2,464, and month two is $1,655, and every month it's a very precise amount, and it's always slightly different. And then you get to month 5 and 6. What you're looking at the last month and the most current month, and it's $5,438 in month 5 and $5,438 in month 6. It's the exact same number. Is that possible? Yes, but the more likely scenario is the credit card charges have not yet been entered onto the balance sheet. So if you were to jump straight to your income statement and make a decision on that profit and loss, you are missing expenses on that profit and loss. So the business is going to look more profitable than otherwise than it really is, and you don't want to make decisions based on that. So that's a big one. It usually jumps straight out at you if you see that credit card balance doesn't change from one month to the next. It probably just means that those transactions has not yet been entered. So again, you can't make decisions on that profit and loss statement yet.
Why should your loan balances be decreasing every month? So
if you look and you have a loan, and let's say it's a loan from the Royal Bank, and it started off at $100,000, and the next month it was $99,000, $98,000, $97,000, $96,000, and then in 2 months it stays $96,000, $96,000. Well, that can mean a number of things, but it should draw your attention. Every month we're making a regular payment on this, and all of a sudden there's a month where it stops. So either A, we actually didn't make the payment, and the bank is going to be upset with us, or B, that payment is sitting in another account causing an error. Maybe it's sitting in interest and bank charges or another expense account, and it makes your profit and loss, it makes it look like you made less money than you actually did when it was a principal loan repayment, right? So it's one of the common things that you look and make sure the loan payments are going down, and also that each sometimes there's more than one loan and each loan payment is getting classified to the right account, right? Which can reduce the headache at year end and trying to prepare this thing. So.
Why is it okay for your corporate tax payable accounts to be negative?
So this is one where normally you look at the assets should all be positive and the payables should all be positive. That's the regular balance. But corporate tax works a little bit different to most interim financials. It's really not worth booking a tax provision month to month. Usually that's kind of overkill and you're getting into the area where, yeah, you can do it, but what's the cost and the significance of that exercise? So normally what happens is you start a business, say you start a business from fresh and you want to make tax installments. You just want to make sure that money's tied up the way it is. We're not going to book that tax expense until month 12. And let's say we estimate that tax is going to be $12,000 in the year. Every month we don't have an expense, but yet we're paying into that tax account. So what it looks is like we've prepaid the tax. So when you prepaid it, you prepaid a liability, you get a negative liability on the balance sheet. So if you see your corporate tax accounts, with a negative increasing number month to month, that just means you're prepaying your tax month to month, and you're prepared for, because at year end that tax bill is actually going to apply to that account, and that negative number theoretically reduced to zero.
Why should you look at the individual transactions in your shareholder loan?
So your shareholder loan is probably, the most significant account for tax purposes, because not only this is income, but this is income that you've taken out of the company. So we're looking at, not just corporate taxes, but looking at personal taxes or at least higher salaries. So, just looking at that shareholder loan balances, you might not drill into every single account when you review your balance sheet, but you should probably view your shareholder loan. It should be very definitive, because what you're looking for is there could be charges that, someone may have thought that they're personal, but they're really a business expense. So if they get put in your shareholder loan, if we put this business expense in your shareholder loan, you're going to end up paying personal tax on that business expense when that expense belongs on the legitimate expense for the business. So and to try to go back on that at year end, that can be a little bit dicey, because you start to wonder, well, what the heck did I buy there? And short of checking every receipt, either it's a long project or something gets missed. So reviewing that shareholder loan, not just the balance, but that's the one where I would say you really got to drill into the ledger each and every month and see, okay, I took $4,000 for myself and I paid my personal tax payments, and that's great. But if you start to see these other expenses, were they really personal in nature? Should I pay personal tax on that, or were they a legitimate business expense that belongs as an expense item? So that's what we have for you here today. Thanks so much for tuning in. Always hit that like and subscribe button. We can continue to deliver you guys tips on helping you beat the odds at business. And if you have any questions, feel free to leave them in the comments below, and we'll do our best to address it in a future video. Thanks very much.